Roger Montgomery from the Montgomery Fund, thanks for joining us.
It's a pleasure, Mark.
Everybody wants to buy low, sell high. That's the fundamentals of investing.
Good luck.
And of course, fundamental to that is you've got to understand how much something's worth before you can appreciate whether it is in fact cheap or whether it's expensive.
That's right.
So how do you go about valuing, and let's talk about the stock market, how do you go about valuing companies?
Okay, the first thing that we do is we separate price from value. So in our formula for calculating intrinsic value, which I'll explain in a moment, in that formula we don't include any price. So PE ratios, which are commonly used to assess value of companies, well, that's just the price. Now if you go to a dinner party and you ask people at the dinner party what's an asset worth, a property, a business, shares, doesn't really matter what the asset is, what's it worth, the common refrain, especially in Australia, will be what someone's prepared to give you for it.
Yeah.
But that's the price. And the price can be influenced by somebody needing to renovate their bathroom, they'll sell shares, or something going on in Syria or the United States or China, or something that's completely unrelated to the underlying business will move the price around. Value moves much more slowly. Now the way to value a business without putting price into it, it's actually really straightforward. Forget about a company, just think about a bank account. And the bank account has, we'll assume it's my bank account, it's got $10 million in it, and I'm going to put it up for auction. The government has said, Roger Montgomery, we really like what you're doing. You're going to have for life a 20% interest rate on your bank account with $10 million in it. I'm going to auction that bank account off. Everyone wants a 20% interest rate. So, especially now. And so I know it's going to be a very popular auction. There's going to be a lot of people bidding at this auction. But what should you pay for that bank account at the auction? What price should you not go above? So if I want a 10% return, let's say Mark, you're attending the auction, you've decided you're going to rule a line at 10%. You want no less than a 10% return if you own this bank account. Okay, the bank account's got 10 million in it, it's throwing off 2 million a year, which is the 20%, it's paying it all out as a dividend or interest, and you're happy with a 10% return. Well, to make that 2 million equivalent to 10%, you could pay $20 million for that bank account. So the formula is just the return on equity, or in this case the interest rate, the return on equity of the business, divided by your required return, multiplied by the equity in the business or the equity in the bank account, $10 million. So we've got 20% divided by 10%, that equals 2. 2 times $10 million is $20 million. And so all we're doing is now putting a line in the sand and saying, right, I'm going to this auction, and every day the stock market is an auction.
Yep.
I'm going to the auction, and if the market can give me, if the market's willing to give me this bank account for less than $20 million, I've got a bargain. But if they want to pay $40 million or $50 million, that's too much, I'm walking away.
Yep.
And that's what we do. All we're doing is applying that to every single company. Now, if any of the interest can be retained and compounded, it's worth a lot more than $20 million. It's worth something more than that. But at least that gives you some idea about how we go about valuing companies.
That's really good, and obviously the big focus is on having a feel for the earnings of the company.
Yes.
and where they're going into the future. What are some of the other things that you're looking for in a company?
Well, we believe we want to buy businesses with bright prospects for growth. So we want businesses that are going to be bigger in the future than they are today. Ideally though, we want them to have a high rate of return on equity. And that's probably to us the most important ratio. The reason why is because if a company has a high rate of return on equity, then every dollar it retains, it can turn into more than $1 of share price performance. If a company has a low rate of return on equity, any money that it retains, it won't pay it to you as a dividend, obviously, it's retained the money, so you're not going to receive it as a dividend. And because, I won't go through the basic arithmetic, but it won't be translated into share price growth either. So if a company retains $1, you're not receiving that dollar as a dividend, and you're not going to get $1 of capital growth if return on equity is low. So we need companies with high rates of return on equity, and that means we avoid things like airlines, we avoid businesses that have very low margin, we're looking for businesses with high profitability because it indicates to us that they may have some pricing power or competitive advantage.
Roger, thanks for the insight. For more insights from Roger and some of our other favourite fund managers, stay tuned to our website.